We saw oil originally spike up massively, a 10% move in one day, but oil has dropped massively since. I mean, I think the markets are telling you what you need to see is that the markets don't think it's really much of anything when it comes to the economics here in the U.S. anyway.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Hey, David, I don't want to this to get lost in the shuffle. We've got some serious news to get to today, but the Open Door Mission, every summer, does a radiothon, a local radiothon. We participate, and I'm not sure if I mentioned this to you. The $5,000 match that you put up, that Retire Smart put up, was matched, and so that raised $10,000 for the cause. And, you know, if listeners aren't familiar, they call it Camp Plus Care. There is a summer camp, but this is also a year-round program.
Yeah, they've really added on to this
educational and recreational activities. Remember, these are children in crisis. These are children that are living in a homeless shelter, so their lives have been turned upside down. And this is an effort to give them some stability and normalcy and some healthy childhood experiences while they're going through the crisis period. Another successful match, David.
Well, you know, we're so blessed to be able to help so many of our charitable friends out there and great organizations right here in Omaha. What I love about Open Door Mission is how far they get that dollar to go. So we do usually two big campaigns.
Efficacy rate is very high for
Well, I mean,
Open Door
they
Mission.
send a kid to the camp for a week for about $50.
Yeah.
So, you know, our $5,000 plus the $5,000 that came in match, that's $10,000. That's 200 kids.
Yeah.
You know, that can go and experience a week. I mean, I don't know if you remember any camps as a kid that you got to go to. These are great experiences, and they're lifelong memories, and you build friendships that can last. I mean, my wife still talks about summer camp she went to as a kid. So anyway, I'm just really glad that, you know, we're able to partner with a great organization and help some people that really deserve it.
Meanwhile, David, in the College World Series, of course, it's like $100 million worth of economic impact for Omaha, and I got a lesson on why. We got your formula. You said, well, let's get one of the Cinderellas, although Coastal Carolina coming in here 1-23 straight. I don't know if that's Cinderella, but they kept rolling and got to the final. And then a perennial favorite, LSU, came through and actually won it. David, my wife and I actually were in New Orleans for most of the week of the College World Series. We were coming home Thursday morning, June 19th, and the person at the United desk was chuckling, saying, well, it was kind of a slow week. And then last night, Wednesday night, LSU qualified for the final. Bam! All of our flights are full this morning going north, you know. And I ended up sitting next to a guy on the plane whose son is a pitcher for LSU. Now, he's a younger guy and a backup. I don't think he saw action in the College World Series, but still. Plane full of jubilant LSU fans heading to Omaha.
We were in Florida visiting Melissa's parents, and then we celebrated our 33rd wedding anniversary this past week, and we flew home Saturday morning, and same thing. Full of LSU. When we were routed from Florida through Houston, United. We were on the same airline, and the United flight from Houston to here was all purple. I mean, it was loaded up. So they show up, they spend some money, and it is really. I think it's about 115 to 117 million is going to be the benefit this year.
Yeah.
Even without the third final game, you and I both always talk about. We love that.
I always root for whoever lost the first game in the final just so we can get a third game.
Absolutely.
But I won't begrudge
one more night the
Tigers.
Restaurants get money, tax base does well. I will tell you that the disappointment, though, was the umpire throwing out Coastal Carolina's coach early in the game. That was literally ridiculous. You know, this is the national championship game, the last game of the season. Give the guy a little grace. I think that was a little ridiculous what happened there. But again, he put a pretty good interview up afterwards. If you haven't seen it, it might be worth pulling up on YouTube or something. But anyway, another successful run here for College World Series.
Really
another great event for Omaha. So cheers to us. And we've got some great news about Omaha coming up later in the show.
Well played. Yeah. GEAUX, go Tigers. I learned that one while I was down in Nolens. All right, 8th championship for LSU. Congratulations. Okay, David, the main event, the main entree. Oh, my goodness. What has happened the last couple of weeks in the Middle East, why don't you give us your recap? Eventually, I want you to land on what does this mean for Americans, especially retired Americans, possible supply chain disruptions, oil prices, market volatility. But first, give us a recap of what has happened the last 2 weeks, including the American intervention.
Well, obviously, so you had Israel and Iran lobbying missiles back and forth, right? And fear of escalation. Would the U.S. get in? Would they not get in? They kept the mission obviously very secret. We went over and used the big bunker buster bombs. We had 125 planes in a mission that no one, got injured, et cetera. So, and thank you to our brave men and women of the armed services and those pilots that were 32, 37 hours in the cockpit straight. Right. That's just amazing precision, et cetera. But so the ramifications to the market is you would think that type of thing would shatter the market and you'd see 1,000-point down day the next day. That's not what happened. The market's actually rallied that Monday, and the idea is that strength through peace, kind of what they're
peace
promoting,
strength,
right? And so the markets kind of said okay, and we saw oil originally spike up. Massively, a 10% move in one day, but oil has dropped massively since. I mean, I just filled up this morning at $2.79, so I can tell you oil is not riveting higher. So the ramifications are really simple. We saw then that Iran posted, hey, we're going to shut down, the parliament voted to shut down the Strait of Hormuz or whatever, and that's about 22% of oil flow goes through that strait. Well, guess where that oil goes? To China. So it would harm China, not the U.S. And so, therefore, they're like, well, maybe we shouldn't close that, right?
Well, plus, as you said about China, they need us as much or more as we need them. Iran needs that oil to flow for revenue. I mean, it's going to hurt itself more than it's going to hurt us.
Correct.
If it shuts the Strait of Hormuz.
There's intelligence reports that maybe the bombings weren't as effective, et cetera. We'll have to examine that later. But I don't think, I think the markets are telling you what you need to see is that the markets don't think it's really much of anything when it comes to the economics here in the U.S. anyway. The markets continue to get pretty close to all-time highs. Now, that doesn't mean we're all clear. We'll show some charts later where we could have some downside here for sure. But I will tell you that what it means to me is inflation is not going to come via the oil, right? So that would be the scare for the economics for Jerome Powell, which, again, is out there trying to tell us that, we can't really cut rates yet. He's starting to look like a fool at this point. I've given Jerome Powell praise, but Trump is, of course, taking a different approach. and
Hold your fire there for a moment because we are going to talk about that. I just want to squeeze this in before we leave this topic, though. Before we sat down to have this conversation, you shared with me a CNBC story. The headline is, NATO allies agree to higher 5% defense spending target. David, I watched the press conference with the NATO secretary and Trump, and he was effusive in his praise of Trump. I mean, the narrative out there is the international community laughs at Trump. Trump's an embarrassment. How could America trot him out there as a leader? Praised it. You mentioned peace through strength. He said you took a strong and decisive action to create peace in the Middle East. And it's time for us in NATO to I think they used to cover 2% of it. Now they're going to cover 5% of the defense
which means we don't
NATO.
have to fund that. People need to understand how dramatic this is. We have been carrying the load for NATO since its inception. And if we're going to continue, he campaigned on it. We're going to make them pay their fair share, so to speak. They have to step up and contribute part of their GDP to the cause, right? And that's the big thing people need to understand is it is a global economy for sure. Now we talk about, protectionism now and, make America great, kind of his mantra here. But global trade's a reality. It's not going away. But it's the globalists that don't want this type of thing because they want to control you from afar. No, we need to protect our sovereignty. I think most people want their country to be proud. And again, we can talk about riots where people are proud of their home countries. Well, maybe they should go there. But anyway.
Well, speaking of proud of your home country, though, I want to point that out because I think Trump has surprised some people because he said, okay, good, this war's over. He said, we ended it and we'll name it the 12-Day War. And it's over because people are saying, are you trying to get us into World War III? And they think make America great again means America's the boss of the world. We're going to dominate everybody. In one of his social media posts, he said, God bless America. God bless Israel. God bless Iran. God bless the world. And MIGA, M-I-G-A, make Iran great again. He wants Iran. He said, forget the nukes, forget hating Jews. Why don't you go back to your tradition? You're great business people. You're smart. There are 90 million of you. You got a bunch of oil. Come on and join the family of happy and prosperous nations. Join the rest of us.
I think there's a lot of folks that are of a younger generation, those that are under, say, 45 years of age, don't remember Iran as we knew it growing up. prior to the revolution that happened in the 1970s. And Iran, there's pictures everywhere. You can see it was a booming economy, very well-educated people there. They flourished. They were good business people. When we lived as kids after my parents got divorced in call it project housing, but one of our neighbors was an Iranian guy who was really sharp. I still remember that today. The Iranian people are wonderful people, but they are ruled currently by what I would call radicals, religious radicals. And, there are others that are saying, hey, you should go overthrow your own government. But yeah, we don't want to do regime change from putting our boots on the ground. If they choose to do that themselves, that's great. But yeah, it's a global economy. And that is where the peace will come from, because you mentioned it, they need the oil sales, right? So that's the great news of tying economically. The wars are now fought financially, hence why tariffs can actually work, because we have to now fight on the financial side, not just conventional warfare. And the economics prove it. The world's awash in debt. Everyone has to pay their bills, and they're going to need cash flow coming to their countries. Well, we're going to get that via tariffs. Iran can get it by selling oil to the world. And cheap oil, more oil flowing, is good for all of us, right? That's good for the economy. It means lower consumer cost of goods, lower cost to ship things, so we all benefit.
Up next, there's trouble in Margaritaville. The estate of the late Jimmy Buffett is snarled in a legal challenge. Our resident authority on estate planning, financial advisor Mike Schudel, joins us next to explain it. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. One of our most popular classes is estate and tax planning in retirement. Another round of those classes is approaching in August, and the main presenter is with us today. David, please welcome financial advisor Mike Schudel.
All right, Chip, thank you. Yes, once again in the studio, we have the man with more letters behind his name than are actually in the alphabet, financial advisor with, man, I don't know how many titles to give you now. We'll just call you Mike. So Mike Schudel's joining us back in the studio today. So I think it's interesting, Mike, you've got an estate and tax planning class coming up here in August. We'll get to that in a bit. But man, you and I talk about this all the time when people have intentions of planning their estate but don't get it done, or they get an estate plan done and they don't revisit, or they make mistakes. And we get to see some of this play out in public, especially when it comes to celebrities. So today, I want to focus in on none other than Jimmy Buffett, obviously he made a pretty good deal of money. He was really smart with his merchandising. I think his estate was approaching $300 million or so.
He's getting close, yes.
Yeah, so married to the same woman for 47 years. So I want to point this out, but his estate is now being challenged. So this is why it is so critically important people understand. We talk about the complexities of second marriages, cohabitants all the time on this show. We're talking about somebody who's been married to the same woman faithfully for almost 5 decades,
3 kids.
Passes away, did the estate planning, at least what he thought was up, wants to leave the money to his wife, then down to the kids, set up proper trust, actually, and there's still problems, right?
Yes, yeah. Well, in our estate planning course that we put on here, we harp on people to get an estate plan done. Well, here's a case where an estate plan was not only done, it was maintained, updated. A lot of it was done exceptionally well. Here was the friction point. Jimmy left his estate. It was approximately $275 million. With joint trustees, his wife and his friend, who was kind of his money manager, business manager during his whole life.
So you would think on the surface that's a great decision, right?
Sounds great.
So the first read I got from this article, I just want to tell you, I was like, holy cow, his business manager's trying to screw over his widow, right?
Yeah.
And that's really not, we don't know all the intricacies,
we don't
right?
know.
But the first read, because he's charging a fee, which, by the way, the trustee should get paid a fee. And actually, when you look, his fee is very reasonable on an estate of this size. I think it's about 0.5%.
Yes.
So, but she's complaining she can't spend her money, et cetera, et cetera. He's complaining, no, I have a fiduciary responsibility and I have to make sure that we manage the assets. And then you pointed out to me that some of these assets, they're just not liquid assets. You can't just, take $10 million out. He owns hotels, bars, collectible items, cars, a cruise ship. Yeah. I mean, there's a lot of things that they're not exactly like liquid assets. And as you pointed out before we did this segment off air, there's cost to maintain these type of assets, right?
Yep. Some assets, cars, homes, things like that, Yes, they can appreciate, especially the kinds that, Jimmy Buffett probably would have owned, but until you sell them, they cost money to own. I can actually speak a little bit on cars. They are not free to buy or free to own.
No, I have a 68 Chevelle that, costs money that my wife yaps about all the time. And I'm like, someday, honey, when I decide to sell it, she's like, well, sell it now. I'm like, no, I don't want to do that. But anyway, but yeah, you're right. It costs money to maintain assets, especially things like cars that have engines and they have to be, turned on, et cetera. You have to store them properly. Artwork, you have to store critically, air conditioned, et cetera. I mean, there's a lot to it. There's a lot of complexities to this.
So let me talk about my takeaway when I read this article. It feels like a person could have reasonably read this, thrown their hands up at the end of the day and said, what in the world do I do then? I mean, I took the time to build my estate. I appointed people that I thought that knew what the heck they were doing, and yet there are still massive problems going on. So is it even worth doing? Well, first off, always do estate planning. I mean, if you don't, Uncle Sam is going to certainly have a big participation in anything that you do, and he should not have a part of any estate more than the absolute minimum amount. Beyond that, though, this is something that we touch on a little bit in the estate and tax planning and retirement presentation that we give, is the things that Jimmy Buffett might have missed out here, in my opinion, is first off, having that very transparent conversation with the interested parties.
Yeah, so the wife and kids,
yes.
This is, hey, we've got a plan. This is how it's going to work. I talk about it all the time. Forecast. You don't have to tell them the dollar amount, but you should be forecasting
Correct.
Relatively what's intended so that there's no infighting on the other side
Yes.
of what's expected. And some people just hold it close to the vest. And typically when it's family, why not telegraph this information?
Well, I hear from clients all the time, I don't want my family to know what they're getting. There might be hard feelings, or I don't want them to feel entitled. I don't want to disincentivize them. Those are all very valid concerns. But at the end of the day, when the parties are hopefully mature enough to understand these things, have a transparent conversation with all interested parties, because any estate plan, as well designed as possible, can always be challenged in court. Now, it might be summarily dismissed on frivolous claims, but you can still cause a court date with expenses, hard feelings, and maybe broken relationships.
Well, I would always point out, listen, money changes things.
People. Yep.
And like I will tell you, my wife still doesn't comprehend the net worth that we've acquired today. It doesn't really resonate. She's not involved in the financial side of the balance sheet of all the businesses, things we own, right? So it's not something that it is crisp. But we do have to have conversations of how this gets managed. She's always asking me, which advisors do I talk to? I've got a list of them, for her, if something were to happen to me. But these are conversations I have to have. The big takeaway to me is, even though he intended to have somebody who would have his best interests at heart, one of his business managers and friends for 5 decades as the manager, I think you and I would agree that was the big red flag on the post analysis of this.
I would
In other
agree.
words, when you have an estate of this magnitude and size, there are corporate trustees that are legally obligated to follow the wishes you have laid out in your trust. They can't make decisions outside of your wishes, but they have a fiduciary responsibility, but they have no emotional
Correct.
connection or tie to the assets. And so therefore they can simply lay it out in a crystal clear way. And I think that is ultimately what the solution they need to do is they need to give up control to a corporate trustee.
Yes.
So that it doesn't, because now there's a relationship there that is being fractured 5 decades.
Absolutely.
And then the kids might get taken sides, et cetera,
Absolutely.
grandkids. I mean, you just don't know what's going to happen.
Could be a mess.
So the bottom line is you need to be planning for your estate, whether it's 200,000, 200 million, 2 billion, it doesn't matter. You need an estate plan, and you need to keep up with the legislative changes based on the state level where you and your beneficiaries live, and that's really important, not just where you live, but what state do your beneficiaries live in. That may change some of the things you design in there.
Absolutely.
And then updated on legislative changes. We're going to have significant tax law passed this year, at least it looks like, that's going to give us an opportunity. It's going to let us basically hold this $15 million federal exemption today. At least that's what it looks like today.
Sure.
But I would recommend, and I've already been looking at some of our higher network clients, they're going to have to change their trusts, because we had forecast that we're going to expire this big exemption and we're going to be pushing assets out. Now we're going to have some time. So now you could even do what's called a series of trusts. You could use a defective grantor trust. You can use Anyway, most people aren't going to be that complex, but the bottom line is they need to have a plan, right?
Yes, sir.
So when is this next class coming up? You and our estate planning attorney that has an office right here on the same floor, Colin Kastrick, teach this class jointly, and it's phenomenal the feedback we get from it.
Yeah, it's Tuesday, August 19th. And Thursday, August 21st at 6:30 p.m. here in our office, the Midwest Learning Center.
And you guys basically take an hour on each of those nights. You only have to come to one of them, but really go through the basics and even a couple complex, rough drafts, if you will, so people understand why you need these type of plans. And you and I met with someone, I think the net worth is well over $100 million at this point, and hadn't really set this stuff up. Now he's going to get a little bit of a reprieve here. He's probably got about 3 years to get it going, but some of the higher end attorneys that we refer to, higher end CPAs that we have to refer these to, they're booked up. So if this bill did not get extended, you couldn't even get the plan that complex in place in time.
Yeah. Just one other comment I'd make is sometimes people get so intimidated by the planning process, which I'm not going to lie and tell you that it's simple and something you're going to get done in 3 hours with an attorney. It's probably going to take multiple months, especially the bigger the estate, the more complexity of the assets inside of the estate. That being said, I've always found it curious because that gentleman that you're referring to, I know exactly who you're talking about. He hasn't done anything.
Yeah.
I bet you anything, cash on the table.
Procrastination is the easiest thing to do, especially in life when you're focused on growing your businesses and spending time with family. But the problem is this is something that you just can't ignore. And it catches up with you at some point in time. And as we're seeing, even when you do the planning, this estate's going to spend tens of millions of dollars now in legal fees that are unnecessary. And anyway, those dollars could be going to either charities or to your children, grandchildren, whatever, lineage, etc.
There it is.
Is that really what you want?
Yes. Why would you work a lifetime to accumulate it and then not usher it through to the next generations?
Yeah, it's our number one core value here, stewardship. We want you to be a good steward of your own resources and assets, but you have to plan for it. So again, that class is coming up August 19th or August 21st at 6:30. Go to our website and click on the events tab and register. Mike, we are out of time. Thanks for stopping in.
Thanks for having me.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about safe havens for an investor. I'm retired and want to keep my portfolio safe and solid. I saw an article that said in times of geopolitical turbulence, investors should consider gold, treasuries, and other government bonds. Do you agree?
Well, when we get to turbulent times, there's often what we call a flight to safety, right? And the idea would be you would sell risk-on assets, stocks in particular, and that money would go over to the flight to quality. And that for the longest time, Chip, for most of my career, has been, in fact, U.S. Treasuries. Now, what's different today versus 5 years ago, 10 years ago, and 30 years ago is the amount of debt that our country now has. We're over $37 trillion. So the flight to safety isn't happening. Instead, it is flying to gold. Now, gold's also known as a safe haven. Another one that has come up as a more recent safe haven in the last decade or so is cryptocurrencies, Bitcoin in particular, right? And so we've seen that as a safe haven for some folks. So if you're going to fly to treasuries for safety, just be cautious of the duration, in other words, the maturity length of said treasuries, because what happens when our debt spiral gets out of control, or if inflation were to come rearing back, interest rates go up. When interest rates go up, the treasuries prices will go down. And if you're not willing to hold to maturity, say 10, 20 years, whatever you buy, you could actually lose money. And in fact, treasuries have lost a great deal of money the last 5 years. I mean, abysmal, some of the worst performance in history. So while I understand, yes, treasuries and gold can be safe havens, you need to have that more of a complex plan, but you also don't want to sell everything, right? You don't want to step away 100% from the market, but that's where you need to have a forward-looking risk allocation that can proactively move things around for you, and that's part of the asset allocation we do in the advanced planning, the A in the SMART plan here. But whoever you're working with, if they're a good advisor, they should already be pre-planning for when you get nervous, right? They should have this conversation with you. So whoever's investing for you, if you're doing it yourself or you're using a professional, have you had that conversation with them? What happens if, the Israel-Iran conflict picks up, geopolitical gets the Russia-Ukraine, whatever it might be, right? China, Taiwan, and the markets were to sell off, how would that affect your portfolio? Someone should have already shown you this through risk parameters. There's tools that are available today for most financial advisors to clearly give you an idea of what the drawdown expectation would be, and are you comfortable with that? And we literally have a risk score that we give every client when we onboard the client, and we agree, we have them sign that they agree to that risk score.
That's part of the report card process.
Absolutely. So you should have that conversation with your advisor, or if you're not getting that conversation, you may be, you may want to give us a call, and we'll do a report card for you complimentary.
Next question, David. You and Mike Schudel were just talking about the mega estate of Jimmy Buffett. Well, this question may resonate more with our typical listener or viewer. Here it is. My wife and I are in our late 50s, and we are beginning to focus on retirement. It seems odd to be told that we have an estate. We have a paid-off home worth about $320,000 and about $500,000 saved for retirement, but we never considered ourselves the type of people who need estate planning. What constitutes an estate?
Your assets. You have an estate. Now, you may not need a really robust, complex estate plan, but you need an estate plan. And that's exactly somebody that should come to the class coming up in August, because we explain the simple things that an estate requires. You need to understand is that your house will pass on to someone. But if you've done no planning, it's going to go through a process called probate, which can add 2 to 4% in expenses to transferring that asset. So let's say you have a house worth, what does it say here, about $320,000. Do you want your children to have to spend $7,500 to take that through probate? You have about $500,000 saved for retirement that you mentioned here in the questionnaire. Again, do you have designated beneficiaries listed on that account? That will avoid probate if it's a 401k, an IRA, et cetera. But what we find, Chip, is that over 60% of people that have 401ks will have a beneficiary, but no contingent beneficiary. So typically it would be your spouse, right? Is going to be the most common beneficiary. But what if you and your spouse, unfortunately, were involved in something like a car accident where you were to unfortunately pass away at the same time, and there's no contingent beneficiary? That now has to go through probate and the courts, right? You're creating undue necessary stress, expenses, and the time with which your beneficiaries could access the capital or the resources you're leaving them. And all can be avoided with a very simple estate plan, which is explained in the class. So yes, everyone has an estate, and everyone needs at least a simple estate plan. And it's not that difficult, but you just have to know the rules.
Here's a question from someone looking ahead, David, about a possible advisor checklist. I'm 32 and looking for a financial advisor. What attributes and red flags should I look for in an advisor?
So if you're 32, I think it's fantastic you're looking for an advisor. We've created a kind of called a Start Smart program. And so what we often do is we have a lot of younger clients now. We're picking up more and more of them. Obviously, most of our clients are retirement age or getting close to that call our firm. But the younger clients, we show them what to do. And the great thing is we want to show them how to avoid the mistakes that their parents most likely make. Like we have to do a lot of unwinding of unfriendly tax investments. People have kind of bought that myth, in my opinion, defer, when in fact, today with legislative changes, you can start investing in dollars. Go ahead and pay the tax bill while they're historically low today. Put the money in various types of accounts, and there's several of them, that these dollars will grow tax deferred. And if you follow all the rules and meet all the requirements, age, et cetera, at the time you assess these accounts, you can take those dollars out, Chip, in the future 100% tax-free. And not only that, the income you'd receive in retirement, especially for a 32-year-old projecting the future, would not affect other tax penalties like Medicare and things. But of course, you're 32, you're not thinking about Medicare, right? This is where a proactive long-term plan can really benefit somebody. And now that we've expanded our advisor headcount here, we have folks that can help someone just like this.
So look for an advisor who's taking the long view and what happens after you retire, not just how do we build up a big pile of money.
Absolutely. And the first thing you want to do is make sure you have all your bases covered, risk management. If you have debt, and most 32-year-olds we meet do, right? Do you understand how to start retiring that debt at an accelerated pace, et cetera? There's a lot that can be done there.
Up next, Omaha and especially Lincoln fared well in a recent survey by Wallet Hub. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, Omaha World Herald headline says, Omaha, Lincoln, ranked among best-run cities in the U.S. This was a survey done by Wallet Hub. 148 cities. Omaha came in at 48. That's the top third. Lincoln finished number 8 in the survey. This is comprehensive financial stability, health, safety, infrastructure, education across the board. And why do you think Omaha and especially Lincoln fared so well?
Well, they are. There's cities that are they're low crime cities relative to other cities of their size, right? Which makes it a very friendly environment. We also have incredibly good healthcare here in Nebraska relative to other cities of our size. So outcomes in healthcare rank pretty well in the survey there. And the economics, it's not that expensive relative, again, to other places. Now, we all complain about property taxes in both of those cities, as a problem here that we need to still fix, and the brain drain problem. But these are great cities to raise families in. Our weather, while we do get some harsh weather, it's not as harsh as other places. So there's a myriad of reasons why these are great cities to live in. But economically, they've been not overwhelming with debt. Now, I do have concerns going forward on that. Will we go down? Omaha, we talked about it several times here in the last years, has gone backwards in its bond rating. Our financial rating is going the wrong direction. We just had a new mayor elected. We'll see what the outcome is. It's too early to call any of Mr. Ewing's policies at this point, but economically, I'm still concerned of bonds that will have to be issued to cover the cost of this free streetcar, et cetera. But anyway, it's nice to see that we rank well, and I think that we should be doing a better job promoting that to college towns, et cetera. So, and big corporate employers here could then help attract talent from other schools, which is the reverse of the brain drain. You want to recruit talent to your city from other colleges, so the corporations here need to get on board and promote these stories.
I guess maybe that's a factor in Lincoln's favor, university town, state capital town.
Yeah,
so,
state capitals and university towns have an embedded economic engine, right?
Yeah.
The money fuels. I mean, we talk about why D.C., 5 of the richest 7 counties in America surround Washington, D.C.
Yeah.
Well, that's because money flows with the government. And so the capital cities seem to do well. I was actually just in Topeka earlier this week, which is the capital city of Kansas. Yeah. And the same thing, it benefits economically. It's a great town to live in. It's a smaller town, much smaller than Omaha here, but for families, I have lots of friends that live down there. It's a great place to raise a family because it's very, very affordable, and they benefit from that economic engine of government and universities. There they have, Washburn University, et cetera.
David, right before we sat down at these microphones to do this show, you sent our team a series of charts about call volume, and I'm not exactly sure what I'm looking at. I think what it means is the do-it-yourself or day traders are really ramping up activity, and what does that mean?
Well, it's not just the do-it-yourselfers. I did make a comment that the retail investor might get burned if they're not careful here. We do have retail investors going all in. You got to remember, we have a whole generation of investors that have never been through a bear market yet. They've been investing for the last 10 to 15 years, other than a quick snap down and a COVID drawdown. They've never really experienced a prolonged recession. We haven't had one in 15 years, or a severe bear market. And remember, the last 2 severe ones were over 50% down, the dot-com era and then the Great Recession of 08-09.
So we have a bunch of people lulled into a false sense of security.
Yeah, they don't believe that these things can happen. Yeah. And I'm here to tell you, I've been doing this for almost 3 decades, a long time. This can happen. I've been through 5 bear markets, et cetera, and it can get ugly. The other thing that's pushing these call volumes up is now the advent of levered ETFs. These are exchange-traded funds that use leverage. Now, we don't use leverage like that for our clients, but retail investors speculate.
Give us a definition of what you mean by leverage.
So they will use options to try and enhance the return. So, for instance, they're on a myriad of stocks. There's over 100 of them out there, but they're single stock ETFs. Like you can buy an exchange-traded fund on NVIDIA, perhaps, one of the stocks that's been the best in class here the last 5 years, right? Amazing growth. But you could buy an ETF that gives you 2 times its performance in theory, but when it goes backwards, which it did, it went from $150 all the way down to $90, you lose 2 times as much money.
So the lever can work against you as well as for you.
And so there's so many people taking on leverage that they don't understand, at least in my humble opinion. When the dam breaks, it gets ugly. And so in that chart, when I sent the call, I sent a couple of just reference charts, and I'm not making any bold predictions, but the first chart was 2000, the dot-com era I just spoke of, where we had a 51% drawdown in the markets. Well, I put up another chart that just showed you the S&P relative 2025 to what we looked like in 2000. And when those wedges break, they break severely. And I'm not predicting it's going to break right now, but I'm just telling you, this is why we like to have some of our clients' assets with zero risk attached to them, principal protected things we can use. And depending on what age it is, it would be different what vehicle we'd recommend. But everybody needs to understand how to properly risk allocate. From that 32-year-old questioner to the 72-year-old retiree, we can show you how to appropriately understand how to use risk mechanisms to protect you versus chasing the hot dot with, extreme leverage, which unfortunately we're seeing more and more of. And the advent of Twitter and people out there doing that, they're promoting this like crazy. And the advent of gambling now, which is everywhere, sadly, this is the mindset of a whole generation. And they'll get burned at the gambling tables or on their apps betting on sports, and they'll do the same thing in the stock market because they do not understand true investing.
David, in the first segment of the show, we were celebrating the statesmanship of Donald Trump, how he's exercised power but also diplomacy in the Middle East and ultimately wanting peace and prosperity for all involved. He got a little frustrated early in the week when it looked like Iran and Israel might be violating the recently declared ceasefire. I think I heard our president let loose with an F-bomb, but otherwise he's been a model of decorum. That has not been the case now as we shift our focus back domestically to the Federal Reserve and Jerome Powell. Trump has unleashed, it's bad Trump. It's temper tantrum Trump. He is calling Jerome Powell, he's mad that the Fed has not yet cut interest rates. He's called him dumb, stupid, a numbskull, a moron, a Trump hater. First of all, here the story you sent me, the headline was frustrated Trump suggests maybe he will need to change his mind about firing Fed Chair Jerome Powell. Is that what it's coming to?
Well, here's the thing. If they're data dependent, I'm with Trump on this. Powell should have already lowered interest rates, and he needs to get on it. Now, you had one Fed governor come out and say, maybe we'll do it in July, right? They're behind the eight ball here. Europe, here's the other thing, Chip, you have to understand. Europe has already cut rates 10 times since last September, right? When we had the cut, Powell, we had inflation of just over 3%. We're making progress, he said, so we're going to cut 50 basis points. And I called him out, well, wait a minute. We're still a long way, 33% from the goal of 2%. And you're cutting 50 basis points? You only do that in history in crisis. So it seems very political when you look back now that he did that maybe to try and help the last administration stay in office. I don't know if that was the motivation or not, but it sure looks like it. Now you flash forward, inflation continued to come down. We all got all the way down to 2.3%, and they stand back. Oh, we can't do it. We're data dependent because we think there may be inflation from these tariffs. Well, there's been no inflation for the tariffs, and when you study economics, they don't actually create inflation. We've gone over that many times. So now he's saying, get this, you ready for this word? Transitory. The suppression inflation is transitory and it's going to rear its ugly head down the road. Well, guess what? If you're data dependent, you can raise rates down the road, but you should be cutting them now. You're harming our country. Trump is absolutely correct because we're financing so much debt at these higher rates when he could simply lower the rates and help our government spend less money.
Wasn't that word transitory? Wasn't that the buzzword? Wasn't that the magic term from a few years ago that inflation would be only transitory?
And we called him out then. We called that was BS
on and on for years.
So I think that it's absolutely ridiculous. Now, I quote her sometimes often. Danielle DiMartino Booth is a macroeconomist. We've quoted her. She's been calling out Powell. Oh, you mean you don't see it? And 31 of the top 100 housing markets in America are negative, Chip, year over year. That is deflationary, and that's the number one component that goes into CPI, the Consumer Price Index, is housing and shelter, the rent equivalents, and those are going down. So it absolutely seems political at this point why they have not lowered interest rates. But again, I'll bring it next week. Brian Westbury from First Trust Portfolios is calling out the Fed as well. They're going to lose $100 billion the way they're running the Fed. And we need to have Congress step in and take some action here.
Well, speaking of Brian Westbury, let's squeeze this in a minute or so we have left, David. Brian Westbury of First Trust, you reference him often. He put out a commentary entitled Dueling Economies. This is comparing the U.S. and China. And if I'm following what he's saying, he says China produces too much but doesn't consume enough. America consumes too much but doesn't produce enough. They both need to find the right equilibrium for their own sakes and for the sake of mutually beneficial trade. Is that what's going on?
Yeah, so when we took the dollar off the gold standard back in Nixon's days, right? The only way to make our fiat currency actually work and stay as the dollar reserve is we had to become a nation of consumers. We had to import. So we had to create these trade imbalances. We had to start importing. Now, that was good for the American consumer. We got goods and services cheaper, right? Textiles, et cetera. And so it was good for China, which was a developing nation then, as they could crank up their factories, employ more people as their population was exploding. So it worked to the benefit of both nations. And of course, Nixon was the first one to go in and kind of get China to become friendly with the U.S., if people remember, right? So now China has massive population, and their population is starting to decline, and the world has other places to get goods and services. So what Scott Bessert from the Treasury Secretary and what Brian Westbury is summarizing in that article from First Trust is, listen, China needs to start to formulate more of a consumption-based economy. They have the employment base, they have the consumers, so why not sell more goods and services there? And the U.S. needs to get back to some manufacturing for its sovereignty, to protect it. So in particular, there are strategic industries we should reshore, which is what Trump is trying to do. Pharmaceuticals being a big one, defense, et cetera, spending, things like that. But we still should have a good, fair trade deal with China and let them manufacture our T-shirts, et cetera, right? So basically, both economies are going to go through a transition. The risk for our investors out there is transitions can come with a period of uncertainty, and markets can reprice during that transition. But the transition is going to happen one way or the other over the next decade.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you must register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, congratulations, LSU, on your 8th title, and thank you for spending money in our local economy. Have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Open Door Mission is a nonprofit 501c3 organization and is not affiliated in any way, nor is it a client of Retire Smart. However, Retire Smart has made charitable donations to Open Door Mission. Financial advisor Mike Schudel has a Juris Doctorate law degree but is not licensed to practice law. Any statements and opinions are general information and not legal advice.